Have you ever really thought about it? What happens to your money the second you deposit it in a bank? I'll give you a hint. It definitely doesn't just sit there in a big, dusty vault. Nope. It goes on this incredible journey, a journey that helps banks turn your cash into billions. So today, we're going to follow the money, step by step.
So yeah, that's the big question, right? What is the bank really doing with your hard-earned cash? We know it's not just locked away. And this is where the real story of how modern banking works actually kicks off.
All right, to make this super simple, let's follow the journey of just one single 100-rupee note. Seriously, if you can understand what happens to this one note, you'll basically understand the entire business model of every bank out there. You ready? Let's do this.
Okay, so this right here, this is the absolute heart of how a bank makes money. It's really just a simple four-step engine. Step 1, you put your money in the bank. Simple enough. Step 2, the bank takes most of that money and loans it out to somebody else. Step 3, they start earning interest on that loan. And finally, step 4, they pay you a little bit of interest for keeping your money with them, and they keep the rest. That difference? That's their profit.
Let's actually put some numbers on this to see how it works. So imagine the bank gives you 4% interest on your 100 rupees. Over a year, you've earned 4 rupees. Not bad. But then, the bank turns around and lends that same money to someone else for, say, a car loan, at 10% interest. So the bank earns 10 rupees. See what's happening? They pay you your 4 rupees, and they get to pocket the 6 rupee difference. That gap, that's what's called the spread, and it's pretty much their main way of making money.
And, this spread actually has a fancy financial name. It's called the net interest margin, or NIM for short. And honestly, if you want to know how healthy a bank is, this is probably the single most important number to look at. A higher NIM just means the bank is making more money from its main job, lending. Now, what does that mean for you? Well, a bank with a really high NIM might be paying you less on your savings or charging others more for loans. It's a trade-off.
And if you're wondering just how big this gets, take a look at this number. This is mind-blowing. The State Bank of India, one of the biggest banks in the country, is expected to make over 2 lakh crore rupees just from this net interest margin in a single year. That's the power of millions of tiny transactions all adding up into one gigantic number.
Okay, but hold on a second. This sounds a little risky, right? Can a bank just lend out all of your money? What if everyone wanted their cash back at once? Well, that would be a disaster, and that's exactly why the Reserve Bank of India, the RBI, steps in with some really strict safety rules to make sure the whole system doesn't come crashing down.
So let's go back to our 100-rupee note. The moment you deposit it, the RBI's rules kick in. Think of it like a pie. A 4.5% slice has to be set aside as something called the cash reserve ratio, or CRR. Then another big 18% slice is for the statutory liquidity ratio, or SLR. So after all that, out of your 100 rupees, the bank only has about 77.5 rupees that it can actually lend out.
And these rules aren't just, random bureaucracy. They are the financial system's ultimate safety net. That CRR, that's basically emergency cash the bank has to park with the RBI. It can't touch it. And the SLR, that's money invested in super safe government bonds. Put them together, and they make sure the bank always has enough liquid cash to handle withdrawals and stop a panic before it starts.
And hey, there's even another layer of protection just for you. Let's say the absolute worst happens and a bank actually fails. It's super rare, but if it does, the RBI has your back. Their deposit insurance scheme guarantees your money is safe up to 5 lakh rupees. So you can sleep at night knowing your savings are protected.
Okay, so now we know how banks make their money and how the RBA keeps them safe. Pretty cool, right? But now let's zoom out. Let's see how the journey of our little 100-rupee note can scale up to impact something massive, like the bank's share price on the stock market.
See, huge banks like HDFC, they're not private businesses. They're publicly listed, which means you and I can buy shares in them. And when they're doing well, they have to announce it. They report these enormous profits. We're talking something like 17,000 crore rupees in just 3 months. A number like that is like a giant flashing sign to the entire market saying, hey, this bank is healthy.
So what do you think happens the second that good news drops? Exactly. Investors get excited and they rush to buy the stock. A killer profit report like that can make the share price shoot up, in this example, by a whole 12%. It's a perfect illustration of the direct line between a bank's day-to-day business and what it's worth on the stock market.
It's really just a simple chain reaction when you think about it. It starts with your deposit.
That helps the bank make loans. The loans create profit. The profit signals to investors that the bank is strong. And those investors buying the stock, that drives the price up. And every single bit of it, starts with that one 100 rupee note.
Wow. So we followed the money all the way from your account through the banking system and right into the stock market. So, what now? The big question is, what do you do with all this information? How can you use this to your advantage?
Well, I see 3 clear paths opening up. First, you can be a smarter customer. You can actually shop around for banks that give you a better deal, higher interest on savings, lower fees. Second, you can be a more informed investor. Now you know to look for things like a healthy NIM and low NPAs. That's non-performing assets, which is just a fancy term for bad loans. And third, hey, you might even think about becoming a banker yourself.
And if that last one sounds interesting, the path is actually pretty clear. You've got roles like a probationary officer or PO and clerk, and you can get in through exams like the IBPS PO. We're talking starting salaries of around 50,000 rupees a month for a PO. It's a really stable and pretty rewarding career.
And the opportunity here is just huge. Seriously, there are over 10,000 vacancies expected to open up soon. The banking industry is always on the lookout for fresh talent to help run what is, let's be honest, the backbone of our entire economy. And just like that, we've come full circle. From one simple deposit all the way to the stock market and even a potential career path. The whole system isn't such a mystery anymore, is it? So the only real question left is, now that you know how it all works, what's your next move going to be? Are you going to be a smarter saver, a sharper investor, or maybe, just maybe, part of the next generation of bankers? The ball's in your court.